Okay, very good morning. Welcome to the briefing then for Thursday the 28th of July. Going to run through a little bit of the news flow we had last night from the Fed with their latest statement, some of the earnings this morning, and then just take a look at the calendar ahead for the session. Just looking at the markets though this morning, so you've just seen some top right here, you can see my chart of the DAX, some pretty whippy price action already. Initially testing down around S1 being rejected, a firm bounce higher through the cash equity open, and then we've just broken the kind of yesterday afternoon high. Looks like some stops just run on that move, but as per the usual summer months, some pretty choppy price action to get things underway, just exacerbated having gone through first half an hour of trade as well of cash equity. Starting off then with the Fed and the FOMC. And you could be fooled for thinking, quite rightly, that we had a very hawkish Fed last night. If you were to have just read the headlines that came out on the likes of Bloomberg and Reuters, some of the other news agencies, they very much focused on one key word. So first of all, let me show you how the news came out on Bloomberg, because I think this really explains then why the market moved like it did. So this guy, you know this guy. If you don't follow him on Twitter already, I suggest you do so. Walter Bloomberg at Delta One. This chap's job, it seems, is just to copy and paste Bloomberg headlines. So if you want to catch news quickly that the professionals are seeing on the terminals, then certainly this guy's a good guy to follow. He's basically here copy and pasted every headline in the order, reverse, let's say, chronologically of how they came out. So this is very important, because when you're trading the news, you've got to trade the information that you see first. And one of the important things is on a Bloomberg terminal, when the statement comes out from the Fed, it normally drops around 10 headlines, of which 2 or even 1 are usually selected as what they call a sticky. So when the 10 headlines drop down the news wires, there will be 1 that remains at the top, which is highlighted in red, which Bloomberg themselves have deemed to be the main comment from that report. But as we all know, with something like the Fed statement, it's much more than just one comment that the market is concerned about. However, the market does react in the short term to the first headline it sees. And in this instance, this was the first headline. Fed leaves policy rate unchanged, and this is the key bit, sees near-term economic risks have diminished. That was the first main red headline ran on Bloomberg. So with that alone, if you're trading the news, there's really only one way you could look at that, and that would be extremely hawkish. 2 of the main factors in which have held back the Fed over the course of the last couple of decisions have been 2 external headwinds, that being China and Brexit. And what they're basically saying then is those external threats have now diminished and gone away. That then would open them up. The underlying economy in the US, we all know from the likes of the housing data, consumer confidence, various other metrics, has been holding up fairly nicely. The other part as well that makes it hawkish is the fact that the Fed offers a more upbeat assessment of the labour and economic conditions. Remember, non-farm payrolls bounced from 11,000 to 287,000 the last time round. So there's been a distinct improvement there. They also said they could raise rates later this year, possibly as early as September. So they're certainly sticking to their guns. Remember, the projections existing from the dot plot matrix we saw in June is still for 2 rate hikes. So they certainly want to keep the door open. Now, the bit that changed this though, well, first of all, let's see how the market reacted to those first comments. And what you can see here is the top left corner is US T-notes, and the bottom left-hand corner is the S&P 500. So this was your initial move when the Fed statement hit at 7 o'clock. You can see here immediate downside pressure in treasuries, and the S&P also fell to the downside. This is because the initial interpretation here that the newswires had focused on were all of a hawkish angle. Risk diminishing and the jobs situation improving. September very much alive, potential for an interest rate hike from the Fed. The only problem is though, that move lasted for about, well, this is a minute candlestick you're looking at in the S&P. The move was reversed within 2 minutes. Likewise, treasuries, after the spike lower of around 10, 11 ticks, we actually then rallied for the rest of the session. So why did that happen? Well, I think there's a couple of things to look at here. Going back to the way the headlines came out, one that wasn't run as a main headline, but seemingly did get more attention, was about inflation. And it was this one in particular that people were looking at. The Fed said that market-based inflation compensation measures remain low. Certainly, one of the key metrics that they're looking for in order to be more comfortable with an interest rate hike is inflation moving to the upside. But they're essentially saying that by their measurement, it remains low, which would mean that, again, this would spell to me they're looking to keep open the possibility to remain credible with their current projections, which are not due to be updated until September, so it's still some way off. They want to still keep open the prospect that potentially they could act, but I still think, and the market thinks, that that's highly unlikely. A couple of other things to kind of cement this. Looking at the statement tracker tool, this is a great tool to use when the statement comes out, because essentially you're relying on the journalists, not analysts, the journalists at Bloomberg to pick the right headlines. And in this case, I can see why they did. The diminished comment about the economic outlook appeared quite cleanly in the second paragraph. The jobs change to compensate for the fact that we had that strong bounce in NFP is up the top. That's clear. But the inflation section here, you would have been able to identify, I think, much quicker by looking at the full document itself. And here you can see they changed the language from market-based measure of inflation compensation declined to changing that word declined to remains low. I think, if anything, we've heard a similar type of situation from the Fed before. We've been in this position a lot in recent months. The Fed intonating towards a possible rate hike, keeping the option on the table, and yet they never deliver because of XYZ reason, whether inflation, whether Brexit, and so on and so forth. We've seen so often it get delayed. I think ultimately the market doesn't really believe the Fed's potential to raise rates in September. Certainly the prospect of one in December, I think, is still a viable option, but looking at what the fixed income futures market, the federal funds, are pricing in, you can see here the chance of a September hike this morning post the Fed statement is 18%. So the market certainly does not believe September at this point in time is going to happen. Well, it's a very small probability at this point. Remember, this needs to be up at the 50% level for it to then be priced in for that month. Before the statement last night, I believe this was only around 19%. So net, I think the Fed have done exactly what most thought. They've just kicked the can down the road, so to speak. They want to keep the possibility of all measures, i.e. they could hike in September. However, that still remains unlikely. They'll still continue to monitor incoming data with a particular focus on inflation. The fact that inflation has really drawn a lot of attention here would mean that from going forward, any inflation type data you get out of the US, I'd be watching very closely. Any signs of an uptick in inflation in the US is likely going to fuel further expectation of a near-term rate hike. Certainly this morning though, the market not buying the hawkish angle. The dollar has been selling off since the FOMC statement. It's taken another leg lower this morning as Europe's come in and they've digested the report. The dollar index down 0.4%. Hence, both your major pairs trading in positive territory. Also, as well, likelihood that given the way that the market's kind of seen this more of a delaying tactic, equities then supported by the fact that rates aren't going to rise anytime soon still, and then corporate earnings is the big thing this morning. The DAX, as I've been speaking, we saw a test higher this morning. It looks like we've just seen another push higher as I've just gone in the last few minutes. So some further strength here. Bund futures, consequently, session lows. Moving on, just taking a quick look at crude, because we did see a pretty big move yesterday. We remain pretty much flatline this morning. I would say the dynamics fundamentally for oil is for a move lower. However, this morning, obviously the dollar is down 0.4, and that might negate any further aggressive downside as the general inverse correlation. However, we did have that big move lower. And recapping again, I know we covered it yesterday, but the main reason behind that was the Department of Energy's inventory data. Not only did we have a surprise headline build against that of what we saw in the APIs, certainly any type of correlation between those two data sets has pretty much gone out the window the last few weeks. But it was the first build in the DOE measure that we've had in around 9 weeks, I believe. Coupled that, and more importantly, US output is going up. And if you remember last Friday, the US rig count is continuing to increase as well. And that highlights a very interesting change in direction of the trend of US crude oil production. You can see here, since mid-2015, certainly through the best part of 2016, we've been on a continued and aggressive downward trend of US crude output. But the last 3 weeks have seen, for the first time in a long time, a pickup from these declines that we've had. I think we've had a trend of around 0.6, 0.1, and yesterday around 0.25% increase in US output. Certainly, if this continues, I'd be expecting at some point that $40 handle to be tested. Okay. Next up then, corporate earnings. And the thing that's important to do is preparation. Now, you get your calendars the day before published on your Trading Live platforms. One thing you can see here is the number of corporate earnings that are coming out. Now, if you remember, before we signed off yesterday, I did say to any stock traders, if you're trading the DAX Eurostoxx futures, you must be aware of the corporate earnings that are coming out that morning if you were trading that index. Especially when you're looking at a situation where you've got things like L'Oreal, Volkswagen, BNP, Renault, Total. These are some of the largest companies, not only in their sector, but in Europe and in some cases in the world. If these companies start showing solid or maybe profit warnings, you're looking at large percentage moves in an individual stock which has a large market capitalization and hence will move the index significantly. Multiply that by several large cap companies, and then these are going to be your main drivers behind what's going to move the index futures once the cash market opens. That's certainly what you've seen this morning. You've seen a big power higher in the equity markets. So, what have we seen for corporate earnings? Well, I've said it before, but if you haven't already, please do so. Follow our main Amplify Trading Twitter account, because first thing I do in the morning is I post a lot of the headline readings that come out for the earnings. Now, one of the sour spots obviously has been some of the oil majors. So Shell's quarterly profits sink 70%. But the market is comfortable with that. We've seen that for quite a long time with the depressed prices in oil we've had since the beginning of the year. This is of no surprise. So again, this is the bar being low, but the company, although it's come below expectations, the market is somewhat comfortable with these oil majors being under pressure from a profit point of view. Total, similarly, has seen their profits drop substantially this morning. However, looking at some of the other companies, BAE Systems and the FTSE first half earnings rise 6.1%. GlaxoSmithKline, one of the largest pharmaceutical companies in the world, not only the FTSE, earnings beat estimates, new product sales have doubled. Telefonica, one of the biggest telecommunication companies in Europe, earnings beat estimates. Danone, first half earnings top estimates. Carrefour, one of the biggest retailers in France, earnings beat estimates. I don't need to continue here. There is a prevalent theme, and no surprise to me then that the index futures are taking some strength on the back of this. This is why it is crucial that you guys are reading the news and being aware of what's come out ahead of your market opening. Now, for you guys who go on in the future to trade full time, if you're trading the DAX, unfortunately, you need to be up at 6 o'clock in the morning to digest the news ahead of 7 when your market opens. I'm just giving you a heads up for what the future holds for you. This is the world that we live in. The most important time of a lot of guys' days, if you're trading or looking to take advantage of the added market movement you always see at around 7, 8 o'clock, then 6 to 8 is really your peak time. And certainly that's when you see a lot of market movement. You can see that if I just look at the euro, for instance. So looking at the euro here on the top right, when did the market move? It moved exactly when Europe came into the market. That's because the dollar index just took a sharp move lower as soon as Europe digested the information from the Fed statement last night. So the early bird does catch the worm in that respect. One other company, just because I spoke about it yesterday about Apple, I did give them a bit of a beasting. I stick by that. One thing that has been impressive though in the tech space has been Facebook. Their shares surged 6% after market. I know Apple surged a similar amount yesterday, but for me, Facebook is a much better sustainable long-term model at this present point than what you're seeing with Apple. Mark Zuckerberg has been extremely astute in picking up things like WhatsApp, Instagram, grabbing the right demographic that are going to use the product, and then most importantly, he's now been able to monetize the product. Now, when you're monetizing through advertising, reaching an audience, this is what we're talking about here. Facebook mobile ad revenue has increased at an exponential rate for Facebook. This is something I remember about 2-3 years ago when we were in 2013. People were thinking Facebook extremely highly overvalued, like a lot of social media names. People also question the ability for the company to monetize the customer base that it has, which obviously is a humongous scale. But they've managed to do that. And companies now, I think, are taking more seriously the reach and scope of an audience that they can capture. So their profits have been rising at a great pace on the back of that. Facebook user growth continues to grow. Over 1.5 billion monthly active users using Facebook. User growth as well, similar rate. It's only on the upward trend. I could literally put the reversed charts on every single one showing Apple against Facebook at the moment, at this present point. So certainly Facebook doing an excellent job on that regard. Right, looking at the schedule for today, one of the things that you're seeing come out this morning, and just for anyone who's not aware of the importance of it, inflation is obviously a key theme for Europe as well. The ECB are wanting to see inflation move up, much like the Fed. And one of the reasons, why the ECB wants to expand QE is to start to stoke inflation again. Although that's proved to be a fairly, not have too much of a greater impact thus far. Certainly the theory should say that by expanding, making the program more powerful, it should ultimately stoke aggregate demand and therefore lift prices and respectively inflation. Now, when looking at the German state CPIs, there's two real important things that I want you to learn from what you're seeing this morning. One is whoever is first to report normally captures the most market attention. That's because generally speaking, most of the German states tend to be aligned. They very rarely differ from one state to another. But the other thing to put in context is certain states are much bigger than the others. So North Rhine-Westphalia is 34% of a weighted area when calculating the pan-German CPI. That's the most populous area of Germany, and so accordingly it's given a larger proportionate weighting. So if you were to look at it technically speaking, North Rhine-Westphalia's CPI contribution is infinitely more important than the likes of Brandenburg or Hesse, for an example. So these are things to contemplate when you look at these single German state CPIs come out. And that's why the overall pan-German figure that comes out later on this morning really is not important, because you've already seen all these single ones report. Okay, a quick look elsewhere. I've just seen on the ticker tape on Trading Live, German unemployment rates just come in, minus 7,000 against expected minus 3,000. The unemployment rate unchanged at 6.1 as expected, so hence you've not seen much movement in the market. Later on then, looking at what the US has on the calendar, you've got the US weekly jobless claims. You've also got US trade balance coming out. So a couple of fairly interesting data points. Also as well though, just be mindful the Fed statement might still have to run its course. And I'd be interested to see, given the fact that newswires have deemed it to be quite hawkish, the market has kind of thought the opposite. I'd just be keeping an eye if the Fed start to break any type of source comments or any scheduled or unscheduled speakers, I should say, from the Fed come out to clarify the situation. That would not be surprising for me at all. Okay guys, that's your morning wrap then. Enjoy your trading session and have a good day. Thank you.